The 30% collapse in silver prices is not an isolated market event. It is a signal. For experienced observers of economic cycles, such a move demands analysis rather than reaction. Silver has historically occupied a unique position within the global system, simultaneously a monetary metal, an industrial input, and a liquidity barometer. When it moves violently, it rarely does so without cause. The scale and speed of the current decline place it outside the boundaries of routine volatility and into the category of structural warning. Historically, silver corrections of this magnitude have occurred during moments of systemic stress rather than ordinary economic slowdowns. During stable expansionary periods, silver tends to fluctuate within defined ranges, reflecting industrial demand, inflation expectations, and currency movements. A collapse approaching 30%, however, has typically coincided with global liquidity shocks, tightening financial conditions, or abrupt shifts in capital flows. The present move, therefore, raises a critical question for decision makers. What is the market attempting to communicate? Unlike equities, which often reflect optimism well into late cycle phases, silver has a record of reacting early to tightening conditions. It is sensitive to credit availability, real interest rates, and the behavior of institutional capital under stress. When leverage is withdrawn from the system, silver is frequently among the first assets to register the impact. This characteristic makes the metal less useful as a short-term speculative instrument and more valuable as an informational asset, one that reveals stress before it becomes visible elsewhere. The current collapse challenges the prevailing narrative that the global economy is navigating a controlled slowdown. If growth were merely decelerating in an orderly fashion, silver prices would more likely reflect stable industrial demand and modest inflation hedging. Instead, the market is pricing something more severe, a withdrawal of risk tolerance and a repricing of liquidity itself. Such moves do not originate from retail sentiment or isolated sector weakness. They emerge when large pools of capital are forced to reduce exposure rapidly. For business leaders and aspiring entrepreneurs, the danger lies not in the price decline itself, but in misinterpreting its meaning. A superficial reading frames the collapse as an opportunity, a discounted asset awaiting a rebound. A deeper reading recognizes that price collapses of this nature often occur before broader adjustments in financial conditions. In past cycles, silver weakness has preceded tightening credit markets, declining industrial activity, and heightened volatility across asset classes. Those who treated the signal as noise paid a significant cost later. Silver's dual role intensifies its signaling power. As an industrial metal, it reflects expectations about manufacturing, technology investment, and global trade. As a monetary metal, it reflects confidence in currencies, real yields, and the stability of the financial system. A sharp decline implies that at least one of these pillars is under strain. When both appear simultaneously, weak industrial expectations and tightening monetary conditions, the implications extend well beyond the silver market itself. Importantly, the collapse is occurring in an environment where surface-level indicators remain misleadingly calm. Equity markets continue to project resilience, corporate earnings narratives emphasize adaptability, and policy messaging stresses stability. Silver, however, operates beneath these narratives. It responds to balance sheet realities rather than optimism. When funding costs rise, when collateral becomes scarce, and when leverage is reduced, silver prices often fall regardless of long-term demand fundamentals. This disconnect between narrative and signal is precisely what makes the current move significant. Another critical aspect is timing. The collapse did not unfold gradually over months of deteriorating data. It occurred rapidly, suggesting forced behavior rather than considered repositioning. Such price action typically reflects margin pressure, liquidity needs, or systemic de-risking. These dynamics are rarely confined to a single market. They propagate. Silver-in's decline may therefore represent an early phase of a broader adjustment process still working its way through the global system. For serious decision makers, the appropriate response at this stage is not to predict a bottom or a rebound. It is to recognize that the signal exists and demands respect. Ignoring early warnings has historically proven costly, particularly for those responsible for capital allocation, business expansion, or long-term strategy. Silver's collapse is not a verdict, it is a message. The challenge lies in understanding what that message implies before it becomes unavoidable elsewhere. This sets the foundation for deeper analysis. To interpret the signal correctly, one must move beyond headlines and examine the mechanics driving the collapse itself. Only then can the broader implications and the strategic choices they impose be properly understood. Have you ever heard of the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt? Back in the 1970s, these two Texas oil billionaires almost cornered the entire global silver market. It's a wild story of ambition, wealth, and a spectacular collapse that shook the financial world. Today, we are diving deep into the story of Silver Thursday and how two brothers nearly brought the system to its knees. It all started in the early 70s. The Hunt brothers, heirs to a massive oil fortune, were worried. They believed that rampant inflation was destroying the value of paper money, like the US dollar. So they looked for a safe haven, something real and tangible. Their choice? Silver? They saw it as an undervalued asset, a physical store of value that couldn't be printed out of thin air by governments. So they started buying, and I don't mean a few silver coins. I mean, they started buying massive amounts of physical silver bullion. They weren't just investing, they were on a mission. By 1979, their strategy went into overdrive. They began using leverage, taking out huge loans to buy silver futures contracts. These are agreements to buy silver at a future date for a set price. This allowed them to control vastly more silver than they could with just their own cash. And the effect was dramatic. The price of silver, which had been hovering around $6 an ounce for years, started to skyrocket. It went from $6 to $10, then $20, then $30. The market was in a frenzy. Everyone was talking about silver. The Hunt brothers, along with some wealthy partners from the Middle East, were estimated to control somewhere between 100 and 200 million ounces of silver. That was roughly half of the world's entire deliverable supply. The peak came in January 1980. The price of silver briefly touched an insane high of nearly $50 an ounce. The Hunt brothers' paper profits were in the billions. They were on top of the world. But here's the thing about financial markets. They don't like being cornered. The massive spike in silver prices caused chaos. Industries that use silver, like photography and electronics, were struggling. Even jewelers were melting down their own silverware to cash in. The regulators and the commodity exchanges got nervous, very nervous. They saw the Hunt's actions as market manipulation, and they decided to step in. The Commodity Exchange, or COMEX, made a game-changing move. They introduced Rule 7, which restricted silver trading to liquidation only. This meant that traders could only sell their existing contracts. No one was allowed to open new long positions. Essentially, they shut the door on anyone else trying to buy. This was the beginning of the end for the Hunts. The buying pressure vanished overnight. With only sellers left in the market, the price had nowhere to go but down. And it didn't just go down, it plummeted. The silver bubble had burst. In just a few days, the price crashed from its peak of nearly $50 back down to around $10 an ounce. The day it all came crashing down is now known as Silver Thursday, March 27th, 1980. The Hunts received a massive margin call for over $100 million. A margin call is when a broker demands more funds to cover potential losses on a leveraged position. The Hunts didn't have the cash. They were over-leveraged and completely exposed. The collapse was so severe it threatened to take down their brokerage firms and even some major banks. The entire financial system teetered on the brink. A bailout was quickly arranged by a consortium of banks to prevent a wider systemic collapse, but the damage was done. The Hunt brothers lost over $1 billion. They went from being some of the richest men in the world to being deeply in debt. They eventually declared bankruptcy in 1988 and were convicted of conspiring to manipulate the market. The story of the Hunt brothers and Silver Thursday is a classic cautionary tale. It shows the incredible power and immense danger of leverage and speculation. It's a reminder that when greed and ambition push markets to their limits, the fallout can be swift, brutal, and affect everyone. It's a fascinating chapter in financial history that we can still learn from today. When silver collapses in isolation, it can be dismissed as a commodity-specific event. When it collapses in the manner now observed, rapidly, decisively, and against a backdrop of official economic reassurance, it takes on a different meaning. Silver's behavior must be interpreted not as a verdict on the metal itself, but as a reflection of the conditions in which capital is currently operating. In this context, the decline functions as a warning signal about the broader global economy. Silver is unusually sensitive to liquidity. Unlike assets supported by steady income streams or explicit policy backing, it relies on confidence in the availability of capital. When liquidity is abundant, silver benefits from speculative participation, hedging demand, and industrial optimism. When liquidity contracts, those same channels reverse quickly. The current collapse therefore suggests that liquidity is tightening more aggressively than surface indicators imply. This tightening is not occurring evenly across the system. Credit markets, particularly outside the most creditworthy sovereigns and corporations, are showing signs of strain. Borrowing costs have risen, refinancing windows have narrowed, and lenders have become more selective. These conditions do not immediately produce recession headlines, but they do alter behavior. Investment decisions are delayed, inventories are reduced, and capital expenditure becomes more conservative. Silver, as an input tied to future production, reacts to these shifts before they appear in official data. Historically, silver has exhibited a tendency to weaken ahead of broader economic slowdowns. In previous cycles, significant declines in silver prices preceded contractions in manufacturing activity, declines in global trade volumes, and stress in emerging markets. This pattern does not imply causation, but it does establish silver as a leading indicator. Its collapse reflects expectations about future conditions rather than current ones. Emerging markets are particularly exposed to this dynamic. Many rely on external financing, commodity exports, and stable global demand. As liquidity tightens and the dollar strengthens, capital flows retreat toward perceived safety. This process increases financial stress in developing economies, reduces industrial output, and weakens currencies. Silver's decline is consistent with such a shift. It suggests that global capital is repositioning defensively, anticipating increased risk rather than expansion. The signal is further reinforced by the divergence between silver and equity markets. Equity valuations continue to reflect optimism about earnings, resilience, technological growth, and policy support. Silver, by contrast, is signaling caution. This divergence has appeared before at critical junctures. In prior episodes, equities maintained strength until liquidity constraints forced a broader reassessment. Silver's weakness, in those cases, proved to be an early indication of the reassessment to come. Another dimension of the warning lies in industrial demand expectations. Silver is deeply embedded in sectors such as electronics, renewable energy, and advanced manufacturing. A collapse in price implies that markets are discounting slower growth or delayed investment in these areas. This does not mean demand will vanish, but it does suggest that expansion plans may be postponed or scaled back. Such behavior is consistent with an environment of higher financing costs and increased uncertainty. It is also important to consider policy constraints. In previous downturns, monetary authorities responded rapidly with stimulus, restoring liquidity and stabilizing asset prices. The current environment is more restrictive. High inflation, elevated debt levels, and political pressures limit the scope for aggressive intervention. Markets are increasingly aware of these constraints. Silver's decline reflects not only current tightening, but also reduced confidence in the speed and effectiveness of future support. For entrepreneurs and business leaders, this combination of signals carries practical implications. A tightening liquidity environment affects hiring, expansion, financing, and risk tolerance. Decisions made under the assumption of abundant capital may prove unsustainable if conditions continue to deteriorate. Silver's collapse, viewed through this lens, serves as an early alert to reassess assumptions about growth, funding, and market stability. Crucially, the warning is not deterministic. A signal is not a forecast. Silver is not predicting an inevitable crisis, but it is indicating that the margin for error is narrowing. In such environments, shocks propagate more quickly and recovery becomes more uneven. Those who recognize the signal early gain time to strengthen balance sheets, preserve optionality, and adapt strategy. As the analysis moves forward, the focus must shift from interpretation to response. The collapse raises a strategic question rather than offering a simple answer. Whether the appropriate action is to engage, to wait, or to withdraw depends on conditions that have not yet fully resolved. Understanding those conditions and the risks of acting prematurely becomes the central challenge addressed next. Have you ever seen the market take a nosedive and felt that knot in your stomach? You're not alone. That gut-wrenching feeling when prices are in free fall is universal. But here's the million-dollar question. Do you buy the dip or do you run for the hills? Today, we're going to dissect this very strategic decision. It's a classic dilemma, one that separates the seasoned investor from the novice. So stick around, because understanding this could fundamentally change your investment game. First, let's get on the same page. What exactly is buying the dip? Simply put, it's purchasing an asset after its price has dropped significantly. The core belief here is that the drop is temporary and the asset's price will eventually recover and climb even higher. It sounds like a fantastic strategy, right? Buy low, sell high, the oldest rule in the book. It's the stuff of legends, where fortunes are made by those who are brave when others are fearful. But let's be real, it's not that simple. The big challenge is figuring out if you're buying a genuine dip or catching a falling knife. A falling knife is an asset that looks like it's just dipping, but it's actually on a long-term downward spiral with no recovery in sight. Buying a falling knife means your investment could keep losing value, potentially all the way to zero. So how do you tell the difference? That's what we're here to explore. To start, you need to become a bit of a detective. Your first clue is understanding the reason behind the price drop. Is it a market-wide panic, maybe triggered by some geopolitical news or a change in interest rates? Often these broad sell-offs drag down perfectly healthy assets along with the troubled ones. This is what we call systemic risk. In these situations, strong, fundamentally sound companies or assets might be on sale for no fault of their own. This could be a prime opportunity to buy the dip. On the other hand, is the drop specific to that one asset? Maybe the company released a terrible earnings report, a major product failed, or there's a scandal brewing in the C-suite. This is idiosyncratic risk. If the bad news points to a fundamental problem with the company's business model or future prospects, that dip might be the beginning of a permanent decline. This is where you need to be extremely cautious. Buying here is a huge gamble. So your first job is to do your homework. Dig into the news, read financial reports, understand the narrative. Don't just look at the price chart. The chart tells you what happened, but the story behind it tells you what might happen next. Are the issues temporary and fixable, or are they deep-rooted and potentially fatal? A company missing its quarterly earnings by a small margin because of a one-time supply chain issue is very different from a company losing its competitive edge to a new technology. Let's talk about a real-world example. Think back to early 2020. The global pandemic hit and markets around the world crashed. It was a sea of red. Everything was down, from tech stocks to travel companies. Many people panicked and sold everything. But those who looked deeper saw that while some industries were genuinely in trouble, others, like technology and e-commerce, were positioned to thrive in the new normal. Investors who bought the dip in solid tech companies during that panic saw incredible returns over the next year. That was a market-wide dip that created bargains. Now for a cautionary tale. Remember companies that were once giants but failed to adapt? Think about Blockbuster. As streaming services like Netflix emerged, Blockbuster's stock price started to fall. Someone looking only at the price might have thought, wow, Blockbuster's so cheap, it's a great time to buy the dip. But they would have missed the fundamental shift in how people consume media. They weren't buying a dip. They were catching a falling knife that never recovered. The company was fundamentally broken. This brings us to our next crucial point, fundamental analysis. This sounds intimidating, but it's really just about assessing the underlying health and value of an asset. For a stock, this means looking at things like its revenue growth, profit margins, debt levels, and its competitive advantage, what some call its moat. A company with strong fundamentals is like a sturdy ship. It can weather a storm. A company with weak fundamentals is a leaky raft that might sink in the slightest turbulence. So when you see a dip, ask yourself, does this company still have a strong business? Is it profitable? Does it have a loyal customer base? Is its management team competent? If the answers are yes, the dip might be a golden opportunity. But if the company is losing money, drowning in debt, and losing customers to competitors, then that price drop is a massive red flag. The risk of running is far lower than the risk of buying. Another powerful tool in your arsenal is your own investment horizon. Are you a short-term trader trying to make a quick buck, or a long-term investor building wealth over years or decades? Your time frame dramatically changes how you should approach a dip. Short-term traders might try to time the bottom perfectly, which is incredibly difficult and risky. A small miscalculation can lead to significant losses. For long-term investors, however, buying the dip is less about timing the absolute bottom and more about acquiring great assets at a discount. If you believe in the long-term potential of an asset, a 20 or 30% drop is a gift. You're not trying to sell it next week. You're planning to hold it for the next 10 years. Over that kind of time frame, the exact entry price becomes less critical. The quality of the asset is what truly matters. A popular strategy for long-term investors is dollar cost averaging, or DCA. Instead of trying to invest a large lump sum at the perfect moment, you invest smaller fixed amounts of money at regular intervals, regardless of the price. When the price is high, your fixed amount buys fewer shares. When the price dips, that same amount buys you more shares. This automatically makes you buy more when prices are low and less when they are high. It takes the emotion out of the equation and is a fantastic way to take advantage of dips without the stress of trying to time the market. But let's not forget the psychological aspect. This is huge. Seeing your portfolio value drop can be terrifying. It triggers our most primal instincts, fear and panic. The urge to sell everything and stop the pain is overwhelming. This is where most people make their biggest mistakes. They sell at the bottom, locking in their losses, and then watch from the sidelines as the market recovers. To successfully buy the dip, you need emotional discipline. You need a plan before the dip happens. Decide in advance what assets you believe in for the long term and at what price levels you'd be comfortable adding to your position. Having a plan written down can be your anchor in a sea of panic. It helps you act rationally when your emotions are screaming at you to do the opposite. Remember, the market rewards patience and discipline, not panic and impulsiveness. Let's summarize the key strategic questions you should ask yourself when faced with a dip. 1. Why is the price dropping? Is it a broad market panic or a problem specific to this asset? 2. What are the fundamentals like? Is this a strong, healthy asset that's temporarily on sale, or is it fundamentally flawed? 3. What is my investment horizon? Am I trying to make a quick trade or invest for the long term? 4. Do I have a plan? Am I acting based on a predetermined strategy or on raw emotion? Answering these questions will help you navigate the chaos and make a more informed decision. There's no single right answer for everyone. A dip that is a clear buy signal for a long-term investor might be a flashing red avoid sign for a short-term trader. Your personal financial situation, risk tolerance, and goals are all part of the equation. So, the next time the market tumbles and everyone is panicking, take a deep breath. See it not as a crisis, but as a moment of strategic decision. Is this your opportunity to be brave while others are fearful? Or is it a warning sign to stay away? By doing your homework, understanding the fundamentals, and controlling your emotions, you can turn a moment of fear into a calculated move that builds long-term wealth. Don't just follow the herd. Think for yourself, analyze the situation, and decide whether to buy the dip or run the risk. Your future self will thank you. Thank you so much for watching all the way to the end. I hope this breakdown helps you feel more confident during the next market downturn. If you found this video helpful, please give it a thumbs up and hit that subscribe button. Don't forget to ring the notification bell so you won't miss our future content. See you in the next video.